Hello, I'm Mike Rich. In this video presentation, we'll discuss how active investment managers can gain an upper hand by leveraging big data technologies. Before we look into how technology can help active managers, let's look into their objective. Active managers are typically measured on their ability to outperform a predetermined benchmark and/or peer group over rolling market cycles. For example, a large blend equity fund may be tasked to outperform the S&P 500 index and/or a group of peers of a similar investment mandate. These managers typically seek to outperform by conducting rigorous fundamental analysis, where they pull apart and dissect a company's financial statements, and then holds interviews with the company's management teams, their suppliers, and competitors to gain greater insights around an investment. Over time, management teams have faced new headwinds, one being that the post-financial crisis monetary policy has largely favored price momentum over fundamentals. This has led to active managers to largely trail their passively managed peers. Teams are also drowning in endless amount of data, which is helping markets to become more efficient. And as markets become more efficient, it is more difficult for active managers to outperform. This is why teams must adapt and embrace big data to remain relevant. One way to remain relevant is to leverage more innovative and efficient economic data. Let's take a look at the Consumer Price Index, or CPI, which is a government measure of inflation. CPI is a backwards-looking index that tracks price fluctuation of a relatively small basket of goods and services over time. The US and other governments around the world typically offers official inflation or CPI reports each month. Today, managers have the ability to leverage more innovative measurements of inflation. One example is the Billion Prices Project, or BPP's CPI. BPP's team, which hails from MIT, uses the internet to track daily price fluctuations from online retailers around the globe. Currently, they monitor in real time roughly 5 million products sold by 300 online retailers in more than 70 countries. BPP offers investors a better predictor of inflation because their information is in real time and takes into account broader data. This rather simple idea also provides investors with a better check on CPI numbers posted by various governments. Inflation data has a huge impact on a manager's view of a specific stock, industry, or the overall market. This is why having the most accurate and timely inflation data is imperative. The next few slides will show BPP versus two government CPI records, the United States and Argentina. The first example is the US CPI, which is deemed as a fairly reliable source. You will see that the two figures here track each other quite well. This does not hold true when comparing BPP to Argentina's official CPI. Argentina is a less reliable source, who has actually been censored by the IMF a few years ago for posting inaccurate economic data. Where reliability is in question, BPP is a great alternative to lever. A second big data tactic is to leverage analytical data from real-time satellite imagery. A market leader in this technology is Orbital Insight, who has developed algorithms to count and measure objects such as cars, agricultural fields and buildings, and more to provide asset management firms, governments, and global nonprofits better insight and intel of the world around them. This could be useful for evaluating Target. If we wanted to see if Target can hit their quarterly sales estimates, one thing that could help would be to view how full their parking lots are nationwide during peak shopping hours. This technology allows one investor to do so. One of the more impactful and interesting examples of this technology is through the review of oil field production. Why would investors want to observe oil fields in real time? Well, like it or not, oil is the lifeblood of the world economy, and its price has great impacts on just about every region and industry around the globe. Let's see this in action. Here is a real example of what a provider like Orbital Insights can provide managers on oil field coverage. In real time, Orbital Insights can offer managers estimates on oil levels in each tank by simply looking at the shadows that cast across a tank's lid. The greater the shadow, the less oil is in the tank. This data is then quantified for ease of client use, which allows investors to use this information tactically in its portfolio management. This technology can report production levels faster than official reports, which most investors rely on. This timing advantage can be advantageous for getting ahead of the curve. The third and final technology tactic to discuss is for teams to employ quantitative models to do much of the heavy lifting. Today's level of data and information flow brings capacity concerns to the traditional manager and analyst team structure. Teams, like Goldman Sachs Insight Equity Team, have built out computer systems that will allow them to read, for example, over 26 million news articles, 1 million research reports, and nearly 300,000 earning call transcripts a year. Through these models, a number of query reports can be made, and these systems can better help point management to areas of interest based on valuation, momentum, sentiment, profitability, or more. This can also help to focus an analyst's attention to a particular market segment or individual security of interest, and it can help teams to build greater conviction over current holdings. Overall, this technology can assist with both the return seeking and risk management objectives of asset management. A couple of questions. Which big data tactics surprised you the most in this presentation? Do you think they can be used in other industries? Could your current employer benefit from any of these technologies? And then what are some alternative ways satellite imagery can help an investment manager gain greater insights on a particular industry, market, or company?